Back to Market on Close. I'm Marley Kaydan here in Chicago alongside Sam Vadas at the New York Stock Exchange. Also joining us now to break down Apple's earnings, George Tsilis, senior markets correspondent here on Schwab Network. We're just moments away from Apple's earnings. And in big picture here, looking for a revenue or EPS beat I should say, from Apple. And the numbers coming across the wire, so let's see if we have it here. Overall revenue numbers coming in at $102.47 billion. Estimates calling for 102.19, so just slightly better than expected there. EPS coming in for the fourth quarter at $1.85. Estimates calling for $1.77. So revenue coming in line with estimates. EPS is a beat. Let's talk about iPhones. This is a very important figure here. iPhone revenue coming in at $49.03 billion, up 6.1% year over year. Their Greater China revenue coming in at $14.49 billion. That is a miss. Expectations looking for $16.43. Wearables, home, and accessories coming in at $9 billion. Estimates calling for $8.64. Mac revenue coming in $8.73 billion, better than expectations there. Operating expenses coming in at $15.91. Estimates calling for $15.75. And their products revenue $73.72 billion. Estimates calling for $73.49. So mostly in there. And then this all-important services revenue number, $28.75 billion, estimates calling for 28.1. So some inline results there in terms of the revenue numbers, an EPS beat overall. We did see a miss in the Chinese markets, though. George, as these numbers are just coming across, also want to make note they're declaring a cash dividend of 26 cents per share as well with this earnings report. The market moving down, though, down 3%. So I'll bring George and Sam back into the conversation here. Inline results better than expected EPS, 6% growth on the iPhones. George, what are some of your initial takeaways here?
Well, I haven't looked at the services breakdown just quite yet in detail. I mean, first off, the rate of change in the phone unit sales are important because that's still the largest constituent, which is now below 50% of total sales. But nonetheless, if you look at the rate of change, last quarter year-over-year was 5.5%. So the 6% this quarter is very meaningful. I think the services breakdown, not necessarily the levels, but the rate of change is going to be important, considering that they're on pace right now on double-digit growth in that division. And it's important, too, because the services is not going to be susceptible seasonality effects like the product revenues are. So they're going to be more consistent. Plus, those are going to be higher margin areas of their overall ecosystem. So I haven't seen that breakdown on services altogether just yet, but if the numbers themselves really represent more than I'd suggest 12 to 13% growth year over year in services, that'll be quite meaningful. So I haven't seen that just yet, but right now we're still trading slightly to the downside. But it's too early to tell in which direction this will go. But I do think that the dividend increase is prudent, considering they're being very conservative, I suggest, as a company, because one of the things I noticed when I was looking at some of the mega caps and even Meta yesterday is the ratio of CapEx to sales in that name was between 25 and 30%. That's high. Apple was quite low. If you just look at CapEx, including R&D expenses last year relative to sales, they're running at around 12% of sales, very low. So that gives me an idea they have a lot of financial flexibility to do things like pay dividends, share buybacks, or even make some strategic acquisitions if prudent.
And, for the full fit, I'm still looking for the services breakdown as the numbers are coming across here. But the milestone for the services business, they surpassed $100 billion in revenue for the fiscal year that ended September. That's the first time they've ever crossed that. It's particularly important because of those higher profit margins than device sales. But Sam, I want to come to you to talk about these device sales. We've had so many conversations about the 17, both domestically and abroad, and its importance in this report. They're seeing 6% increase, but even more importantly than that, expecting a 10 to 12% growth in the December quarter. Is this enough to signal that we might, in fact, be in this upgrade cycle, or dare I say super cycle that we've had a lot of people mentioning to us, as opposed to a pull forward effect?
I think in the absence of, a really strong AI narrative here, the feeling from the analysts is that, at least as iPhone 17 demand is carrying us through for now. And so I suppose, people have been saying that it does look good. And I think these numbers are probably going to be enough to suggest that as far as that storyline is concerned. Certainly they want to see momentum in this as far as the street is concerned. And there has been some expectation that, with some of these expectations that you've just heard from the company itself, that many do believe that it can be sustained into 2027. Now, the China part was quite interesting, I also found, with regards to that revenue miss, as you said, because this has been a really big part of the story, particularly because they just returned to growth last quarter in that market. No doubt this is a very key and important market for Apple, particularly with regards to those new phones. I'm just wondering if this had something to do with the fact that the iPhone Air, that very thin one, the Hershey's bar as someone likes to call it, was actually delayed over in China, and that was because they had to get the local carriers, the networks, ready to basically adjust to the eSIM technology, which China is a little bit behind in, and that's why it was actually only released this month, and they actually did see a strong showing. So I'm just wondering if, maybe it's just not capturing some of that demand that we saw because they actually had to push that release date back. But, I think also what China has been very much a big focus for this company as well, and certainly the analysts, as I said, in lieu of the lack of an AI narrative, which seems to be sort of the elephant in the room. But it just feels like the market has continued to be very patient with Apple on that part of the story, and will continue to be so until about summer next year, as far as the folks over at CFRA were telling me today.
Yes, and I've heard similar sentiments. So I want to start going category by category if we can. This wearables, home, and accessories category was one that was flagged earlier for me, just in case if they weren't showing any growth here. Coming in ahead of expectations at $9.01 billion, estimates calling for $8.64 billion. But, George, they were at $9 billion a year ago. So is beating the expectation going to be enough? Still under a little bit of pressure, down only about 1%, likely everyone waiting for the call and some of the commentary. But in this particular category, is a beat, but the same as last year, enough when you're Apple?
Yeah. I mean, that's a good point to bring up. At the end of the day, you want growth in yield. And if you're not generating growth in yield in certain divisions, you have to make up for it in others. So, they'll get a pass because it is a small division overall relative to the total revenue base. But nonetheless, if they do show expansion in other areas and margin expansion in other areas, that can certainly make up for it. Because again, the home products and wearables, there's always going to be some trial and error based upon the types of technology people want, and they're also going to be changing that. So it's always going to be a low margin business to begin with. So it really comes down to the ecosystem revenues. And I think, and this is just my view of the larger context of Apple, it's a great brand, great products, very popular, installed units in the billions. But right now, the theme is AI. And, I suggest the company's been very conservative in the last year on CapEx, R&D. It's almost like they're being very patient and waiting. But their device revenue has been improving. And I can see this because pricing power is still intact. That's a very good sign. Gross margins, at least excluding the quarter they just reported, last year up 350 basis points, but their net income margin was down 50 basis points. So it seems like they're playing some catch up in other areas. But nonetheless, I did make a calculation quickly, but their services revenue for the quarter, which was the beat at over 28 billion, was higher by 13.2, roughly speaking, % compared to last year. So that's very meaningful. But I think right now the market, and I think analysts too, are waiting for some update on the integration strategy with artificial intelligence. And maybe the strategy is to basically, capitulate and use other technologies, AI-based, in their successful product lineup.
And Sam, coming over to you, we've had many of these conversations about Apple, not really staking its claim in this AI race and being a tepid participant. As far as what people were saying to you that they're looking for on the call by way of commentary surrounding this AI narrative, what were you hearing?
So what I was hearing was that on AI, they're going to be coming out with the typical commentary as far as analysts are concerned. And that is because they really need to get it right. And as I mentioned, many are putting a circle on the calendar at around summer next year. So anticipating the market to remain fairly patient here, particularly on the AI side of the business. But they very much seem to think, the analysts that I spoke to, that they need to put up good enough numbers, certainly on the hardware side of the business, business, which it seems like they've cleared the bar somewhat, particularly on the iPhone 17 demand, which seems to be gaining traction here in order to offset, any of the concerns or at least delays or, how patient the market needs to be with the AI story. As far as with respect to the capex, a lot of the analysts have been sort of saying they're a little bit more sort of isolated from the capex concerns, asset light in terms of capital intensive type of a business. But I would just say also I have noticed that CNBC has actually spoken to Cook ahead of this earnings release, and he had been telling them that they still plan to release an updated version of Siri next year. And also on the China part of the business, they do say that they do expect China to return to growth in the December quarter as well, and expect growth this quarter to be really based on the reception of the iPhone there, these iPhone 17 family. They anticipate that demand to continue in the following quarter as well.
Yeah, and just to recap here with Apple, EPS coming in at $1.85, better than expectations for $1.73. Total sales coming in at $102.5 billion, just slightly better than the estimates they were looking for. And the shares are seesawing about 1% above and 1% below the numbers over concerns that Apple may potentially be losing some ground here in some former growth markets. But the call remains. Lots of important questions will be there, and we'll continue talking about this. But we want to thank George Tsilis for being with us to break down the numbers as they came across the wire.